Ladies and gentlemen of the crypto space, we're live on a Friday, August 25th at 11:32 a.m. We're going to look at technical data today. We try and assess directionality to see where we're going from here. We have a general sense of directionality at the largest of time frames, but it's nice to get a sense on a weekly basis, and if you're insistent on inflicting self-harm, you could try and get a sense on a daily basis. But the shorter the time frame gets, the more unnecessary emotional effects are caused to you. The volatility drives you nuts. What is it doing? Who is saying what? Is things going up? Is things going down? And that's not the methodology that I like to enact. I don't find that sustainable. I don't find that way of engaging with markets healthy. We need a different way. It's what I've said for this entire time, talking on this stream for these years, to entertain a different way of managing capital. So the title of the stream is Levels of Survival. So that obviously indicates the prevailing short-term directionality. But this is a great metaphor. So if you have a significant drop in income, you still are surviving. You still have income, and that's the whole point. It's just levels, and you're able to adapt to accommodate the change in levels. As the metaphor stands with the matrix, the change in energy availability levels. You have to do less. You accommodate. But the whole point is it's cyclical over a reasonable, rational time horizon. So as the cyclicality in the short term is pointing in a downward direction, there'll be a time when there's better times, more liquidity, so on and so forth. Wow, starting out the stream with 16 folks. Hit that thumbs up button. I appreciate all of you. We're looking at the DXY, and it broke the 104 barrier. As always, there's chances for reversal from in the short term if you're looking at it on the 4 hour or the daily, but you'll drive yourself nuts. The shortest I'm going is probably the weekly in this regard, and frankly, it's the last remaining decent moving average of resistance to the upside. We already pushed above the 200 SMA on the daily, and don't even kid yourself looking at a 4 hour chart on the DXY. You're looking at the weekly. Zoom out to the monthly real quick, and there's also no moving averages in sight to the upside. And we'll pull over to Japan in a second because that's the predominant force that's in play right now on the DXY chart. But, if your expectations are from a short-term perspective and you're hoping that there's some sort of loftiness or support in risk assets in crypto markets, then you are hoping for resistance at this 50 SMA. We'll probably know in a week or two, maybe three, whether we push through or not. Maybe you get a hold at resistance, holds as resistance, falls back down, maybe a support on the 100 SMA, and maybe it's another month or two of this chop heading into October, early November maybe. But this is where we are, and this directionality basically indicates to me that the odds are we have levels of survival we must entertain. So that's what I've said this year. What survives? That's the most important thing. And what survives is the most meaningful. And this is the type of environment that will show you what survives. And that's the same thing that happened in 2000. What survived? The curing of malinvestment. You can't invest in crap in a low liquidity, relatively high interest rate environment. Those types of enterprises don't survive. And frankly, the vast majority of bullshit that people allocate capital to in the crypto space is not enterprise. It's nothing. There's nothing significant to it. It doesn't offer a product or a service. And I hope as we head into future cycles, folks will really appreciate that we've talked about this for all these years, and as these entities, as these capital allocations, as enterprise. It's an investment in a business. So what's the cash flow of the business? Look at this shit as traditional value investing. And obviously, we expect earnings to come down on the equities markets. If you look at ES, this thing probably put in a decent lower high at this point. Where's that? Look at these moving averages. They got rejected down to the 4 hours too short. But check this out on the daily. Look at that. The 50 SMA got rejected on the S&P. Ain't that something? So obviously, you're always at a crossroads. Is it going to hold support of the 100 SMA? Or is it going to break through? And then you have lower lows. That's basically where you are. Next lower low from this candle on the left, you'd probably see it maybe touching 100 SMA or pushing through. But this is not a good looking chart for the expression of resistance at a previous support. Support tested here, held, pushed up, support breach, retest, previous support flipped resistance. That's how and the trifecta of bearish confluence is the lower low. Breach, retest, lower low. And then you have pretty much good confluence indicating further downside directionality. As of right now, from a daily chart, this is a pretty decent positioning for a directionality reversal from previous highs, printing those lower lows. And we'll start to see that cascade unless something changes basically with Japan. And this looks very precarious. We are right. This is days that we're pushing to break to a fresh higher high. And most meaningfully is we already pushed to a higher high. You see this, that we flipped previous resistance back in June into support. That's quite a precarious situation, especially from a DXY perspective, and just this gives us our perspective on international liquidity conditions. Look over in China, basically looks very similar. Previous high, previous resistance, expressing support. It's all about an expression. So where the price dollar, the yuan denominated dollar, there was lack of buyers to push it to a higher level. Now it came down to that same price where there's lack of buyers, and buyers are stepping in. They're like, oh, this is a discount. And that's what an expression of previous resistance flipping to support means. Move still in a precarious situation. Too short a time frame. Zoom out to the weekly. Clear this. Maybe we'll get a good perspective and see what's going on. Still chop. This is more of like a crab type of presentation of data. Still no indication of significant directionality, albeit we do see a little bit of previous support flipping resistance, maybe this 50 SMA, but I don't expect trends to hold on this chart to the same degree that they hold on price action. Volatility is a different type of trend. It's not like people are directly causing this value to go up and down by buying or selling. This is a knock-on effect of buying and selling. So it's a second order type of data set. Overall, that's where we are from a macroeconomic perspective. So overall, what's my expectations for crypto markets? I expect any asset that can be sold will be sold. Liquid assets will be sold. Clearly, in a liquid asset that can't be sold won't be sold. So there's interesting dynamics going on in 2023 as compared to previous cycles, and that's meaningful. That's different. It is different this time. And there's this concept of dollar liability capture we've talked about, the concept of emerging markets, which we talked about. So I expect a system to exist. I expect liabilities to exist. There's a lot of traditional enterprise talking more and more about liabilities and using these crypto dollar liabilities in their traditional enterprise, their meat space enterprise. So all the signs are there for me to indicate there is a reduced state of this ecosystem. It's going to continue to contract, but as it contracts, it solidifies and it becomes reinforced and supported, not just internally, but by external participants, becomes stronger. This is literally the condensation of bullshit into something that is actually meaningful. So this is quite nice to see. As much as it's relatively undesirable from a price point perspective, this is the revelation of what actually is versus what everyone thought was. And there was nothing to all that exuberant price action, all those stupid assets that people bought because of memes and trends. In the end, all there is credit, FX, and liability printing, and derivatives for gambling. But that's it. That's the business. That's the innovation that has occurred in the last 3+ years at this point. 3+ years, not the beginning of crypto, because this is not the same thing as what existed in previous cycles. This is different. This is an emerging market that has occurred in the last couple of years. Dan's in the house. Tap C, Gaffer, Sarko, surviving into 27. Well, there's a reasonable time horizon. If you have capital that was deployed, that remains deployed, those are the types of time horizons that gives you a sense of comfort. You're not like, oh, what's the price action going on today? You can't really get a sense. You will get a sense of where things are heading into the coming years, and that's exciting. And for me, I need to see that, and I've structured the portfolio and the capital such that I'm in the front row seat to see what's coming in the midterm to the long term, and the short term is mostly noise. It will drive you nuts. One curious view, pleasure. JM, curve price is depressing. I love to get it at 30 cents, but it's sad watching it go down. Well, last week's revenue it's been about the same revenue for the last 5 weeks. So far, August cash flow is about the same as the beginning of the year, and it's up significantly. We're talking like February, March cash flow this month. So this is part of the conversation that I've tried to have to peer through the bullshit. It's not the price point of curve that matters, it's the cash flow that it offers. So when an asset that is continuing to produce cash flow in depreciative markets and the cash flow continues, that's what you want to see. So you're not looking at the curve price, you're looking at the cash flow chart. And you know why I say this and what I'm thinking about when I say this? I'm looking at my QuickBooks and I'm seeing my month-over-month cash flow report, and I'm trying to envision the chart of it. And the chart is a relatively consistent number. Obviously, at the beginning of 22, when things started to come down significantly, there was elevated cash flow conditions on a month-over-month basis. And things have come down significantly since end of 21, beginning of 22, but that was the top. But for all of 22 and 23, the cash flow has been relatively consistent. And that means a lot. And if it comes down meaningfully, we get 25, 30, 40% drop in cash flow from here. Okay, there's levels of survival we must entertain, and that's the whole point of the cover image for today's stream. But the cash flow is still there. And that's the whole point. That's what they've been trying to teach in meat space from a dividend investor perspective, that is no longer a viable path of capital management execution because it's just so minimal and it's just such a predatory environment that as long as it's the X, Y, and Z equation. The X is how much capital, what's the price point? What is the yield on that price point? So, $10,000 and 30% returns is $3,000 a year. And Z, what is the likelihood of that cash flow to continue into the future? And that's the capital management equation, the reduced, simplified capital management equation that I appreciate most nowadays. And in that regard, these prices are actually getting interesting. So what you'll find is the same thing with bonds. As the price point of these assets come down and as cash flow through these enterprises continue, you'll see an inverse correlation between price point and the yield and the APR that is offered, that is received by engaging with these enterprises. So the yield goes up as the price points come down to buy into these enterprises. So don't be too sad. The only thing to be sad about is maybe not enough free cash to acquire. But then you have to consider position size, and maybe you're over allocated. You have to remain rational with regard to portfolio composition. Are you overexposed to one thing versus another? And maybe it's not necessarily the time to deploy cash, even if price points are depreciated. Maybe you need that cash for other things. Maybe you need that cash to manage real life expenses and those kinds of leverage. Always can remember that, like a loan on a car or a loan on a house, a mortgage, that's called leverage. So, folks take on those types of debts too easily without really understanding what they are from a capital management standpoint. And most of the time, it inflicts self-harm. Very unfortunate. Paul DePetro, pleasure. Ryan, hey, big cap mentor, Captain Rationale. Well, we got to be rational because look at this damn chart. Very few folks remain in this space. And I see that in my content. I see that on Discord, obviously. I see that on Twitter. And, I wish folks could do better. I'm calm, cool, collected, engaging with these markets, and I don't trade. I don't engage like that. I've spent all of 22 restructuring capital management, and I rebuilt the psychology and my mental state around looking at my capital in a different way. It's not the price point, it's the cash flow, and I live my life around the cash flow. If the cash flow's down, I have to cut back. Hey, honey, we have a certain amount of honey with regard to my wife. We have a certain amount of capital per month, and that I expect that capital to come down, and we adjust accordingly. We do one less activity. We buy different things with regard to consumer staples, or we spend less, but we still have cash flow, and that's meaningful. And I always tell her when times are good, and they will be good in the future. It may take a couple of years, 1, 2, 3 years, but when times are good, we can enjoy. When times are bad, you cut back. You constrain yourselves to be contained within what you actually can finance based on your available cash flow. Well, maybe we could keep this stream short for a Friday, but overall, we'll see what happens in markets. But today's Jackson Hole wasn't very interesting in most regards. All eyes on Japan mostly. Where's the euro? Euro is in a more favorable spot as compared to Japan because it's actually expressing resistance on the 100 SMA and is a general bearish downtrend, very much consistent with the structure and shape of the DXY, whereas Japan pushed right through. It didn't hold as resistance any of these moving averages. It didn't even hit as support. It fell right through the 50 SMA. Didn't even hit the 100 SMA and the weekly as support. Look at the remarkable difference in that chart. This fell all the way down to the 100 SMA and failed to even need to get to resistance at the 50 SMA. The yen, on the other hand, in a precarious situation, obviously putting that upward pressure on the DXY. But Japan holds a lot of the cards, maybe even much more of the cards as compared to Europe, and certainly China. China certainly has a capacity to export a significant amount of deflation if any of their large real estate components go delinquent and fail to pay debt holders. Then people that own that debt, wherever they are in the world, don't get paid. So it's a capital destructive process. Thus, they have a capacity to export a significant quantity of deflationary pressures on the system, which will carry right over to Japan and the other large G7 nations that are the predominant contributors to the global liquidity composition. So plenty of things on the horizon that indicate lots of contracting liquidity pressures. Nothing is resolved, and the directionality with regard to Fed talking points, monetary policy, don't look like they're changing anytime soon. There's plenty of things that could force that to change, U.S. domestic fiscal conditions, but I don't even think that is putting significant pressure currently. Obviously, Treasury market disorder will be an indicator that could put in bottom. Maybe we see a significant move. You see significant volatility here, like a blowout to the upside. You see a big buy straight down to 3.0 in like a week, and that's going to be a fair amount of disorder. Or you see straight up to 4.755 in a week. That's disorder. And guess what? Where will you see that data? You'll see that right in the move. Volatility goes both ways. You see a move down in yields or up in yields by a percent. You're going to see a volatility spike right up to 170 again. Maybe it's a lower high as compared to March of 23. But that was a hell of a spike. This was a big pin, that big pin in the top of global liquidity conditions, and then all the countries outside the U.S. started loosening policy. U.S. was still tightening policy, and that was the entire story for basically 22. And that's the deal. I hope that helps, ladies and gentlemen. Um, you know, there's not much alpha on this channel. This is a channel mostly about survival and reconditioning, reprogramming for a more sustainable way to engage with markets. And to me, that's most meaningful. My expectation is when markets get hot in the coming years, I'm going to be the one that's sitting back, clicking a button once a week, or clicking several buttons a couple of times a week. But it's not buying and selling. It's literally just getting cash flow because I did the work. I did the work years earlier to understand why these systems are different as compared to 16, 17 and earlier cycles. Why what emerged post 2019, starting in 2020, was a very different system. Why it was new and it was something meaningful. I appreciate all of you. Tell everyone to subscribe. Check Discord for links to the most rational community in the entire crypto space. I really appreciate everyone in there, and we will continue to survive together, and we will all have front row seats when better times come back. Catch you next time. Peace.